This is the McKinsey podcast, where we help you make sense out of our world's toughest business challenges.
Welcome to the show. I'm Lucia Rahili.
And I'm Roberta Fasara.
I was talking to some experts, and they were saying, yes, you could actually have AI listening in on a meeting and identifying biases. I think the biggest roadblock is whether companies or executives are willing to actually let a technology tool tell them that they're doing something wrong.
That's McKinsey senior partner Tim Kohler talking about how AI could help leaders make better decisions. In a minute, you'll hear Tim and I talk about the updates to his business school bedrock, valuation. Tim also shares thoughts on the legacy of Warren Buffett, who steps down from Berkshire Hathaway at the end of this year. The conversation is excerpted from our Author Talks series.
But first, just a heads up on a couple of timely podcasts on McKinsey.com. The first relates to the ongoing uncertainty and geopolitical dynamics and the tariff landscape, and talks about how leaders can navigate global trade shifts. And the second is a piece of research from our Institute for Economic Mobility and covers innovative solutions to the affordable housing crisis. That's obviously always a relevant and serious topic, but I think it is particularly interesting right now, given the new news that LA has reported a decline in the number of folks who are unhoused for the second straight year. You can find both pieces on our website and in our show notes. Now let's hear all about valuations.
Hey, Tim, thanks for joining the podcast today.
I'm happy to be here, as always.
So listen, after 60 years, Warren Buffett recently made the announcement that he's stepping down from Berkshire Hathaway at the end of the year. Talk to me a little bit about his legacy. What impact has he had on the business world?
So I think his legacy is more his courage to think independently and to invest that way and not necessarily invest on what the latest trend or fad is, to take a very long-term view, to do the work to think about what are the long-term economics of a particular business based on facts and analysis, and based on the ability of a business to generate cash flow.
This long-term view, why did this approach work for Warren Buffett?
It's not just successful for him. We've studied this and we've found that companies that take a longer-term approach do outperform over a longer period of time. And when we've looked at even well-known companies, we see a lot of well-known companies that fall into a short-term trap, right? They do well for a while, and then they find that in order to keep their profits and cash flow growing, they have to focus on short-term cost cutting, which customers notice, which is eventually bad for the long-term growth of the business. And these are well-known, well-respected companies that eventually run into some difficulties because they don't adjust with the times. They don't adjust with what the long-term trends are.
Recently, Buffett spoke out against the situation going on with global trade. How does that jibe with his investing approach?
That is a unusual circumstance where he's commenting on policy type of issues and talking about the economy. And he does that from time to time, right? Usually when he does that, like when he's talking about global trade or whatever, he is reinforcing what many thoughtful economists would be saying. He has a bigger voice in many cases, right? So hopefully that message gets through. Very few economists would say that free trade, or mostly free trade, is a bad thing and that tariffs and other things distort. So he's not saying something that's unique. He's just making it much more visible than it would be otherwise.
Tim, at the end of the day, what's the one key takeaway for you from Warren Buffett's career?
The one key takeaway is being an independent thinker. And what I mean by that is looking at the facts objectively, looking at what's going to happen longer term in terms of the quality of a company's products, the trends in the industry, et cetera, very, very dispassionately, whether you're an investor or an executive, and making decisions based on that and not trying to go against that, because you can't go against the market, right? If consumers are changing their behaviors, you can't pretend it's not going to happen, right? You need to move more quickly than most companies are willing to move, for example.
And now let's hear more about valuation. Tim, this is now the 8th edition of Valuation. If we look back to the very first edition, why did you and your co-authors want to write this book?
Actually, we never set out to write a book. We had recently, in the late 80s, started the McKinsey corporate finance practice. And we wanted to make sure that all the McKinsey consultants around the world were doing high quality, rigorous financial analysis the same way. And we also observed that there were no books or materials that were of the standard that we felt was important in terms of the level of detail and rigor and those kind of things. So we wrote a manual for McKinsey consultants on how to do valuations. It's in a 3-ring binder. I still have a copy of it. We never intended it as a textbook. It's become a textbook of our leading business schools. We keep on adding more and more content, and we learn more and more things.
You've said it many times that the principles of valuation don't really change, but the world does. So how does this book help business leaders deal with that change?
What we have found is that it's actually when people overly focus on what's going on in the world and forget about the principles, that's when they make poor decisions. So I do remember back around the dot-com bubble, say 1999, people were talking about a new economy. The principles of not just of valuation, but of economics, didn't apply anymore. There was a so-called new economy. There was a belief at that time that if you just got big fast, you would eventually make big profits, right? Almost regardless of the industry. So we actually had electric utilities that were buying power plants around the world with no synergies. Almost all of those went out of business that were doing that because there was no economic logic to any of them. Size did not bring any benefits. Sometimes size just leads to complexity. So whenever we've been in those kinds of situations, I find that looking back to the principles helps me to understand what's going on better and where the future may lead us. So for example, right now, this is more specifically related to valuation. We have a handful of companies with enormous valuations, well over $1 trillion. And one of the things I've learned over the years is to sort of say, what do you have to believe in order for those values to be justified? And we can then analyze and say, okay, are these numbers reasonable? What might be driving those valuations up, and are they sustainable? So the principles I find really do help me understand the world, whatever geography it is, whatever time it is. I always go back to the principles to help me understand what's going on and to think about how that might play out in the future.
What is the most misunderstood concept of valuation?
What business leaders most often get wrong today and 35 years ago when we wrote the first edition is they believe that the stock market is only focused on short-term earnings, and particularly accounting earnings or earnings per share as a primary metric when making strategic decisions. And they are often too short-term oriented because they believe the market demands that. Our research and our interviews and stuff like that have shown that there are a lot of long-term investors out there. In fact, if you add together the index funds, retail investors, and the long-term institutional investors, that probably accounts for 75% of the market. And yet it's these short-term investors who are very noisy. They ask lots of questions. They're looking for what's going to move the share price in the very short term. And so executives, boards of directors often think that they're the ones who drive the market. But the evidence shows that that's not the case. And so what we encourage companies to do is to have the courage to be more long-term oriented, to focus more on growth and innovation, for example, rather than just, increasing profits by cutting costs. So the focus on earnings, in particular short-term earnings, is still the biggest misconception that we battle with all the time.
What are the top 2 or 3 issues facing business leaders today?
I think that the right way to think about that question is, if I'm an executive, what is out there that's going to affect my company and over what time frame? For example, I was talking to a senior executive of a very large retail chain, grocery retail chain. This was a couple of years ago when there was a lot of concern about a recession, and they were considering cutting back capital expenditures. And we had a conversation, and it turns out that I found out that it typically takes 2 to 3 years to build a new store. And yet the typical recession only lasts 12 months or less. So the time frame of many investments is longer than the recession. And so if you don't make that investment today, 2 or 3 years from now, you may be behind. And all the research that we've done says oftentimes recessions are the best time to make investments. And the other thing in the case of the grocery chain is, once again, it's a question of, do you think about it at the aggregate or do you think about it more a micro market level? I think that one of the big issues, both for the US and many other countries in Europe and Asia, is the growth of the federal debt. Keeps on growing. We've reached a point where we're almost at a point where we're spending more on interest expense than on defense. And eventually that's not sustainable. The typical solution that most countries have resorted to is to print money, which leads to inflation as a way of reducing the value of the debt. So thinking about how to deal with inflation is certainly one of the issues that I would be concerned about if I was a senior executive. The other one is sustainability or climate change, I should say. Well, once again, it's a matter of how it affects my company, my industry. What are really the issues that I'm going to face? Some companies are big emitters of carbon. They have more direct concerns. Some have indirect concerns, and some have other types of concerns. So figuring out what really matters and what's the magnitude for you, and not trying to do the same thing that everyone else is doing. What I also find is that companies don't always do a good job of communicating to investors that they understand how these issues affect their company specifically and what they're doing about it, and not panicking or not trying to deal with or talking about every single thing under the sun. Focus on what's really relevant to your company.
You and your co-authors have written tons about biases in decision-making. How should executives think about bias and its effect on their decisions?
So, for example, one of the biases that large companies in particular have is loss aversion. They weight losses much more than gains. And as a result, they're unwilling to undertake investments that are risky but may have massive payouts. One of the techniques that you can use is to look at investments as part of a portfolio rather than the risk of an individual investment. And you find that when you look at your portfolio projects, the overall risk is a lot lower. Another example is groupthink. A lot of companies don't have a very strong debate culture. And as a result of that, you have to take some actions to almost force a debate, right? You can do things like you can assigning someone to be a devil's advocate. You can ask for people to, at the beginning of a meeting, to have a secret ballot so you get a sense of where people are leaning, and are there other people leaning in the direction I'm leaning, which is going to give me confidence to speak up. Another big bias that companies fall into the trap of is confirmation bias, which is looking for data which confirms what you want to believe as opposed to disconfirms. And you need techniques to help you overcome that. One technique is called the pre-mortem, which is just forcing yourself to analyze all the things that can go wrong. I was recently having a conversation with someone about AI and whether or not AI can help us with this, right? I was talking to some experts and they were saying, yes, you could actually have AI listening in on a meeting and identifying biases. Maybe head of the meeting is dominating the meeting and not getting input from other people. Could identify confirmation bias, et cetera, real time. I think the biggest roadblock is whether companies or executives are willing to actually let the technology tool tell them that they're doing something wrong.
Geopolitics is very much in the news today. How can it affect valuations?
It's all about digging underneath the surface. What I find in looking at the valuation of companies is that, yes, it does enter into valuations, but investors are smart enough to figure out how material those issues are to a specific company. So if a company is particularly vulnerable to, let's say, their supply chain in China, right? The market does reflect that, and investors will put pressure on managers to diversify their supply chain, for example. So investors know what's going on, but they try to be as specific as possible in understanding what the risks are and how they will affect individual companies and what companies might do about that, or how can companies better prepare for those risks? Do they have contingency plans? Do they take actions ahead of time, et cetera? So yes, there is an impact, but it is very focused on individual companies or individual industries and not a big sort of massive discount in the market because of geopolitical concerns.
Tim, this is a perennial issue, and I know it's something that you've talked a lot about. This question of how can companies balance shareholder expectations for the short term and for the longer term?
I think it is important to understand that, once again, it's a question of short-term versus long-term value creation. I can do things to pump up my share price in the short term. I can cut costs, et cetera. And let's suppose that I cut costs, I fire a bunch of employees that are maybe important. In the long term, do you reduce the quality of the product or the quality of the service, et cetera? You will boost your short-term profits. The market may not understand it because it's sort of hidden to them, but everybody will eventually lose. The customers will be unhappy, the employees will be unhappy, and the shareholders will be unhappy a couple of years down the road. I've seen that. Cutting costs is never a way to succeed. I've never seen a company in all my years that has successfully cut costs. It can do it for 4, 5, 6 years sometimes, but eventually it comes back to haunt them, and they find that their growth is below their market, right? And then they have to scramble to figure out how to fix it, or if they can't even fix it.
All right. So then what should companies do?
I think that we need to shift away in the conversation from short-term share price to say, okay, how do I balance the needs of different stakeholders over the long term? Now, that said, that doesn't mean you want to overpay your employees at the expense of shareholders. You want to pay them enough that they are loyal to you and that they're satisfied, but you don't need to go beyond that. Same thing with the prices you charge your customers. You could always provide more benefits to customers by lowering prices and lowering profits and returns to shareholders. But if they're satisfied and they're happy and they're buying your products, you don't need to lower the price more than the amount that helps you to maximize shareholder value and get the balance right. There's another area in terms of the environment, though, which is important, which we also have to balance. And the stakeholder there is the broader community. And there the decisions, once again, are difficult because it's not always straightforward who's responsible, what's the role of government versus companies, et cetera. An example of that might be in the chemical world, if people are concerned about the impact in plastics on the environment. And yet, if I'm a chemical company, should I just stop making certain plastics? People had analyzed this and found that certain plastics, for example, are essential for food preservation. And right now we don't have alternatives. And the impact of plastics is probably smaller, the negative impact, rather than the positive impact on food preservation, which is important to feeding people around the world. So there's a tough balancing act that has to be undertaken by executives. Now, it's almost never a good thing to purposely pollute. As an economy, we mitigate pollution or greenhouse gas emissions at the level where the costs are the least, right? And we need to figure out ways to do that.
So would a great CFO or CEO from 1990, when the first edition of Valuation was published, be a great CFO or CEO today? Or are there just too many uncertainties in the world for them to thrive?
First of all, I'm not convinced that the uncertainty level today is that much higher than it's always been. We've always thought that wherever we were was the highest level of uncertainty. And if I look back over my career, I think the highest level of uncertainty I've experienced was actually before my career in the late 70s, when we had both inflation and unemployment in the US. And there was tremendous uncertainty about how we would fix that. And that was very painful, probably more painful than anything we're experiencing right now. But that said, I don't think the characteristics of a great CEO have changed. I think a great CEO, they have to be good strategists, which means understanding in detail the economics of their businesses that they're in and being able to make courageous long-term decisions about what to do. If a business is declining, should I shut it down or should I sell it? If there's a new opportunity, should I invest in it? How much do I invest in it? A lot of companies see opportunities, but they don't invest enough to really be winners. And so the winners are often the small companies that don't have any baggage. Being confident enough to be a contrarian at times. If you look back to Warren Buffett, is successful because he's been a contrarian. If I look at the banks that survived more successfully the financial crisis, they didn't jump on the mortgage-backed securities bandwagon. They pulled back because they said, yeah, this doesn't make sense, right? They were courageous enough to go against the conventional wisdom. I think also talent management is another big motivating people. Those are all skills that have always been important for CBS.
What's been most surprising about your work on this project?
I came out of the University of Chicago with an MBA in 1981, and I was a firm believer in market efficiency, almost to the extent of market perfection. The stock markets couldn't do any wrong. And what I've learned over the years is that the stock market is very good at valuing companies for the most part. But there are times when the stock market gets it wrong. And now I know why it gets it wrong. And the reason is because when you learn about the theory, well, you think that people can buy and sell just as easily. And so you have buyers and sellers balancing each other out. And what we find in real life is that there are times in certain stocks, not for the market as a whole, where a group of investors might be buying without doing any of the numbers because they're excited, the company's in the news. That pushes up the share price. Then you've got professional traders who trade on momentum, pushing up the share price. Then you've got big funds that are concerned that they don't have those hot stocks in their portfolio, so they buy the shares. All these things pushing up the share price. And it's very difficult to push or risky to be a short seller to move in the opposite direction. There just aren't enough of them, and it's way expensive and risky. So that's how we end up with bubbles in stocks from time to time. They always go away, but now I understand at least why they come about, and we can understand it. So for example, right now, if you look at the 7 largest companies by market cap, you see that the ownership of their shares is very different than the rest of the rest of the 500 companies. They have about twice as many retail investors, individual investors, as most other companies. Okay. To me, that's a sign that retail investors who typically don't get their computers out and build a spreadsheet to figure out whether they should buy a company's shares or not. They buy it based on what people are saying, what the news says, whether it's going up or not. And so when you have a lot of retail investors in the stock, that's typically a sign to me that maybe there's an imbalance in the way the stock is being traded, and to be cautious about that.
Tim, as always, so great speaking with you. Thanks for joining today.
Thank you, Roberta.
Thanks so much for listening to the McKinsey podcast. I'm Lucia Rahili.
And I'm Roberta Fasaro.
Find us on McKinsey.com. We'll have a transcript of this episode up shortly.
And download the McKinsey Insights app, where you can find this podcast and other helpful content updated daily.
If you enjoyed the show, we'd love for you to leave a rating and a review.
We'll see you in 2 weeks.